Welcome back to another episode of Not Financial Advice. I'm Sean, and if this is your first time joining us, what we're looking at here is my entire portfolio. And what I offer to my audience is uploads 3 to 5 times a week minimum, talking about how the market is doing by contrasting it to my well diversified portfolio, showing you what sectors and stocks are moving the market up or down. Additionally, what we do here is we review stocks over on Qualtrum from our subscribers who request a stock review. So always feel free to ask me to take a look at by putting a stocks ticker in the comments below. Importantly, I'll ask you to like the video and subscribe to my channel. Turn the bell post notifications on because what we offer here is total transparency of a regular guy's investment journey. That started in 2021 with stimulus money, not unlike many of you. No formal background in this. Part of what my journey and experience has been is in having a lot of ups and downs. Um, I've realized maybe $600 in profit and never taken a loss. Any gains or losses that I have are unrealized. So I'm a long-term value investor with a little bit of a tilt towards defensive stocks and consumer stocks, as that's my circle of competence. Um, but yeah, what we do here is upload, show you the good news, show you the bad news with total transparency. And if that's the type of content that you enjoy seeing here on YouTube, go ahead and make sure that you're subscribed. So, today, what we're going to be doing is a review of my three worst investments of all time, which is, not meant to be an entirely serious phrase because I certainly see bright futures for all of these companies. The market just doesn't agree with me yet. I was too soon, hopefully not 5 or 10 years too soon, because that would prove to be a problem in the long term. But we're going to dive into this, see how my portfolio is doing here about 45 minutes before market close. It is Friday, January 5th of 2024. We're going to jump right into it right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, so today the S&P 500 is flat. The Dow Jones Industrial Average is flat. The Nasdaq is down 0.8%, and the Russell 2000 is down nearly 0.5%. Yet today I'm up 0.16%, which is good for about $110 of gains on the day. So let's take a look today at what is moving the market and in more specificity, my portfolio. So what we can actually see today are marijuana names surging for 3 days in a row. And I think this would be as good of a time as any to sort of paint a picture of my investing journey. So, I got involved in the markets as it was racing up when everyone else had stimulus checks because that's when people were talking about the markets. And so that's a little bit of a lesson that you can hear. If you're attracted to the markets for the first time, it's often the case that the market is doing really, really well. And so people are what is referred to as exuberant or, irrationally excited about the market. Same thing for an individual stock. When your friend is, making hundreds of dollars a day on some given stock, we as humans like to be part of the crowd, and we jump in without the correct framework or research. And so that's something I certainly did, especially on a company called Trulieve, which is here leading the day. Ironically, couldn't have planned it. But this is the third day that marijuana stocks are getting a bid. The Biden administration had the FDA suggest that marijuana be rescheduled to Schedule 3, which would allow marijuana companies to write off expenses on taxes, reducing their income tax rate from essentially 80% down to a more normal rate for businesses, maybe 25%, which would boost earnings per share conceivably. And so marijuana stocks are the only thing holding my portfolio up today, much higher than the market on a relative term. up about $100, up about $100 today, while the market is flat or down 0.4%. And so, what we'll also do here is take a look at some of the other more mainstream names that are doing well in the market today. January 5th, the Friday, last trading day of the first week of the first month of the new year, 2024. And so I'm seeing some positive signs. I'm seeing some of these weird, smaller and value type companies that may have debt or higher dividends and look more attractive when rates go down and yields go down. And so I'm seeing some more participation that I haven't seen for the first trading week here. This is looking similar to the everything rally we had for the previous 9 weeks, but I'm seeing Foot Locker up 3.2% on the day, seeing Smith and Wesson up 1.9% on the day. We'll come back to that. But also seeing, weird names like U-Haul or Walgreens up 1.5%. Cyclicals like Scott's Miracle Grow up 1.33%. Some consumer defensive names like Turning Point Brands up 1%, with some industrials like Home Depot, Cummins, and Caterpillar also doing well. And so that's what's been moving the market upwards today. As far as things that are not doing as well, we're also seeing sort of a mixed bag here. So we're seeing that, Apple decline, which is bringing the index down. We're also seeing Coinbase down. We're seeing gold miners down. They were up the other day. And then just interestingly, some other defensive names like Pepsi and Procter and Gamble, which are defensive by nature, but may be somewhat overvalued, which answers for their very small position sizing here in my portfolio. Those names are down as well. Yeah, and so there doesn't seem to be a lot going on in the market today. Only piece of significant news we had was a jobs report, which was just kind of, not too hot, not too cold, just right. And so that's an update on the portfolio today. So I'm going to ask you to like the video and subscribe to the channel and turn those bell notifications on, because we're about to jump right into it and cover my three worst investments ever. And so we'll start with number three, which is in fact Amazon. And so Amazon's a stock that's done really good over the years. But interestingly, we can see here that Amazon has, significantly underperformed, and they are now no higher than they were towards the end of the market recovery for COVID in 2024. So they've underperformed for 3.5 years while having some really promising developments. And as I alluded to earlier, when I first took notice of this stock, was probably somewhere around here. Um, as it started to race up, I got that FOMO and bought nearly at all-time highs. And so, looking at my notes here, I'm down about 12% on this stock, or just around $768. And so, my buy-in price, my buy-in price was towards the top of the market, down or around that amount. I have done some dollar cost averaging down, but another lesson that I learned that I like to share with all of you is, be aware that when your attention is drawn to a stock, it's usually due to that psychological reason that it's gone up, and you have that fear of missing out. And that ties into another lesson, which is position sizing. So in some of my past videos, what I've learned in the last 3 or so years, is I think I would have been better off investing half of my money into, you know, vanilla index funds, broad based, maybe Vanguard VT total world index stock market, and then having another portfolio of between 20 to 25 or even 50 stocks that I could buy smaller amounts of and then opportunistically buy on weakness. But unfortunately for me, I all in went all in on this stock near an all-time high, and have paid the price for that, and it's weighed down the returns of my portfolio. But with this stock, being essentially flat over the last 4 years, while the company has made improvements, while the company has been making progress, I have optimism about this stock moving into 2024. And one of the reasons for that is what they did in 2022. And that's where you saw that big, deep gully in the stock. With COVID, demand for consumer products shipped directly to your front door was pulled forward by a lot. When I first looked at this investment, it was projected that in 5 or 10 years, 40% of all consumer spending will be online. And it was clear to me that Amazon was a leader in that. Um, Funnily enough, as I learned more and more, I learned that the investment in Amazon is more so an investment in AWS or cloud, as well as advertising and prime reoccurring subscriptions. So I didn't even fully understand the stock when I invested in it. I just saw the trucks going up and down the road. I thought I should buy six or seven, $8,000 of it. But while that stock went down, what happened is they had that pull forward of demand, and they went ahead and did a lot of capex or capital expenditures or investments in the business that may have essentially weighed down the returns of their company. Going into an investment cycle, you have to plant a seed for a tree before it can grow. And so now for the next 10 or 20 years, Amazon is able to reach more and more homes with same or next day delivery, which brings people into that Apple ecosystem of paying that reoccurring Prime membership, which eventually will rise every couple of years along and plus inflation. But yeah, that's why I'm down 700 or 800 bucks on the stock, 12%. And that was another problem is I went so huge into it that fear of it going down prevented me from sufficiently dollar cost averaging in. And so most people who hold Amazon are up and I'm not, but in the long term, I feel really optimistic. And so let's go over here now to Qualtrim, which I mentioned to you earlier. This is a suite of software that I use to look at stocks, but not one that I am affiliated with. And so I'll leave a link for Qualtrim in the description below. But let's take a look at some of this stuff that makes me feel, remaining bullish on Amazon as my largest holding, about 9% of my portfolio. So we can see it's up about 0.2% today, trading for $145. And what I'm seeing here is revenue that's going up and to the right, somewhere around 17% a year, 12 to 17% a year in the more recent years. But a really, smooth looking up into the right revenue chart. What we can also see is free cash flow, free cash flow that at times has been negative before becoming positive, before becoming really positive. And these are the investment and then reaping cycles that we see with Amazon. They're very comfortable to invest really heavily in themselves. And now we've seen 3 really good years of free cash flow. And these 2 years, I do not believe are the future for the company, but the price of the stock has gone down because of it. And so what we can also see is that Amazon is doing a good job with keeping a war chest of cash. We see massive growth in earnings per share, which helps to move the stock price. We can see decent returns on capital employed for such a large company. Unfortunately, they're slightly diluting shareholders. And again, an unfortunate thing, their expenses are going up, but they do have that moderately high return on capital employed. And so I just have a lot of faith, and I've had to put a lot of trust into this company with so much of my money wrapped up into it. But let's take a look on the quarterly basis and see how things have been going. And so, yeah, we can see a return in the most recent few quarters. Let's look over the last 5 years. We can see some of these years that brought us down negative on the year, but we're seeing a return to profitability. And I have a feeling that the Christmas and Black Friday season for Amazon is going to show up really good in their next quarterly earning report. So fingers crossed. But that's where we will leave that one at. I'll ask you to like the video and subscribe to the channel. Turn the bell on if you're enjoying this type of content so far. And now we're going to come over to my second worst investment of all time, which is Smith and Wesson brands. And so I know a little bit more about firearms than the average junior analyst on Wall Street. And so I felt a good amount of confidence to go into this position, probably around 3 or 4% of my portfolio. But I'm down on this stock, somewhere around 35%, down about $1,141. And so this example is going to be very similar to some of the things that I mentioned before about hearing about a stock. It's because it's gone up, most likely. And considering position sizing, but also, understanding that some stocks are cyclical and others aren't. So both Amazon and Smith and Wesson are cyclical, and so I bought them at a time with a very euphoric time in the market with a lot of money, liquidity being pumped in by the Federal Reserve. And so when that cyclicality shifted, I didn't have the information or the education that I'm hoping to provide to you to understand the right way to hold cyclical stocks. But what we can see here on this chart is very interesting. So, a firearms brand, they make a quality product. I think they're one of the top three or so manufacturers of firearms from a quality and innovation standpoint. But what we can see is this company races up before elections and then drops dramatically. Races up before elections, dropping dramatically. And so if only you can be an educated and disciplined investor, you could see how this stock could help you to get really outsized returns. And then obviously here we had this black swan event. Um, we had this black swan event, which was also, surrounding a presidential election year, but more than ever up, over 300%. But then as demand dropped down, we've seen some steep declines. But looking more recently, as we're coming back into this election and with the cycles of the market shifting, seeing some, pretty promising signs for improvement on this stock, especially when we consider that long-term chart. And so what we'll do is we'll get over here and just sort of see some of the things that we can learn about this company and the products that they make. And so they do make a very high quality product that's well regarded, used by many police agencies in the United States, which can definitely influence consumer behavior in this space. But they are just flooding the market with innovative products. So this is an improved version of a budget firearm that they've improved with better trigger, and so this is new. They just dropped it unannounced. They're responding to different regulatory things and trends in the market by making a rifle that takes their pistol magazines, and so that's sort of like a Apple like thing. When you buy their phone, you're going to get their computer. In this case, if you own some of these pistols, you can get a rifle that uses the same magazines and ammunition. But innovation and copying other companies with pistols in rare calibers is bringing excitement to people in buying new arms, so on and so forth. So, um, they've really just done a good job, and they've also had some capital expenditure moving to Tennessee from Massachusetts due to regulatory things. So regulatory risk is also something you always have to really keep in mind. And at the same time, I don't see gun rights going away in the United States. If they are curtailed, about 70 or 80% of the revenue on this company does come from pistols, which have some special protection from the Supreme Court. But the trend for the regulation on this is positive. And so I see bright things in the future for the stock. I'll continue to hold it down about 35% as I've been down at least 50% on this stock and have averaged in. But let's get over here to Qualtrum and see some of the metrics, that give me this confidence in this company. And so revenue is up and to the right. This was a huge pull forward. If we sort of normalize the last 10 years, it's about a steady 3 or 4% revenue growth. So this is a small cap value stock, which often you can get a premium on. So I feel pretty good about that. As far as free cash flow, similar stories. Um, and COVID really touched this stock, and it's part of what drew my attention to it. But some of the same stories with capex, um, and just cyclicality. But what we can see here is that, for the most part, they have good free cash flow. They do a really good job with keeping debt low. If they acquire debt, they pay it off, but they have a great 3.6% dividend yield, which is for the most part looks pretty safe. We're coming into the season where they should be getting, some more cash flow on recent reports. The fourth quarter is usually best for this industry, from my experience. But additionally, we can see that they buy back shares, and they have the capability to have some really strong return on capital employed, which is a great predictor for the performance of the stock. But yeah, I mean that'll pretty much cover this company as we move right along. I'll remind you to like the video if you haven't already, and subscribe to the channel. Turn the bell notifications on, as I'm here to bring you transparent financial education and entertainment, and here to serve my base of subscribers. So thank you so much for your support. We're going to get into number one, which is Trulieve, the number one stock in my portfolio today, but actually my number one worst investment of all time as far as total returns. So really similar stories of going in too heavily um, when the market was hot and when stocks, were at all time highs in so many words in layman's terms. But down only about 75%. I would say, you know, I'm actually really happy about what this investment has taught me. And what it's taught me is that I can withstand Great Depression level drawdowns in a stock without panicking, without losing sight of my 5, 10, 20-year prediction on a stock. And so that's not something that a lot of people can do, but it also accounts for my dramatic underperformance in my portfolio. But as many great investors have said, an individual investor has a benefit in the sense that I don't have shareholders or other investors to be beholden to. And so I can hold my losses or sell my gains or do whatever the heck I want to do. And that's certainly what I'm doing here as well, because my thesis on this stock is marijuana, not unlike beer, eventually will become a consumer defensive stock. It is a stock or a field that will have increasingly better regulatory environment, will become more societally accepted, as it did with all these funny movies in the 2000s and 2010s, but ultimately that this will be viewed as a consumer defensive, not as a discretionary, but also a consumer defensive that has some medical properties. And so I view this as a stock that in the long term will have growing, revenue, um, steady cash flows, and will become less volatile as it has been, closer to that of a meme stock or Kathy Wood's ARK, and more so of a durable sector of the US stock market, say in 5 or 10 years. And so I've got time to let this thesis play out. But additionally, what we can see is that on this company, Florida is eyeing becoming a recreational marijuana state in 2024. They got close a few years ago, but it didn't go through. But as you can see here, the Supreme Court appears to be open to this initiative. And recently, we've seen states, like Missouri, and others, more traditionally Republican states, Oklahoma, have legalized marijuana. And so I see Trulieve, which holds about a 65% market share in Florida, with an aging demographic, but also a growing population. Trulieve holds a near monopoly on medical cannabis in Florida, and I see them as being a huge beneficiary from potential legalization, be it this year on a statewide basis or in the future, 3, 5, 7 years, however long it takes for America to get its act right on this no brainer issue. So, looking at this company, this is one where the government's also deciding whether it's going to be rescheduled, and this company will be able to write off expenses on taxes. But right now they have about an 80% effective tax rate. But this is known as a company that has, one of the better balance sheets in this very troubled space. So as we can see here, they have about 1/3 cash to 2/3 debt. But additionally, what we can see on the company, Trulieve, not a very old company as far as it's being publicly traded, but really strong revenue growth, probably somewhere around 35% a year going forward. But additionally, we can see that they have had years where they've been able to post earnings per share. They've been having a problem with cash flow in more recent years. But additionally, when we take a look at the free cash flow, which is really hard here, it's non-existent on this company, and I do blame the government for that. We can definitely see some issues there, but also maybe some recovery as well. When I look at it on a quarterly basis, we've seen, despite their 80% effective tax rate, that they've been able to post positive free cash flow, um, into the tune of about $50 million a quarter, when they have been profitable in this last year. So definitely proud of my company for doing that. But again, one that I'm down 75% on, when I've been down on as much as 90%. And one that, thankfully, due to position size, I wasn't too emotionally damaged to dollar cost average back into, which I've done, which has brought my average down, which I think will be great over the next 5, 10, 15, 20 years. But yeah, so that's what we're kind of looking at with this company. Going back to the annual chart here, I would say that I think it's trading at about fair value. But if you were to give it credit on a constant basis for, say, um, even $20 million a year in free cash flow, which I think would be conservative, I think there's a chance that, there's 25% upside in that intermediate term. So, you know, um, looking at all of this as well, they don't have a lot of traditional finance options. They are doing some dilution, but it's much lower than other cannabis companies, and super duper high returns on capital employed. They have the ability to do that, at least, even back to 2016, pretty high numbers. So feeling great about this stock as well. And so, folks, that's it. Those are my top three worst investments of all time. But I think, as we saw when we started the video out, things can change, and things can change quickly. And so that's why we don't time the market. That's why we stay invested. That's why we do our research, make sure we know what we own, and, stick to our process, not being distracted by the fluctuations in the market, and just sticking to our process. So there we go. My worst performing stock of all time is my best performing stock of a day. Hopefully, a sign of things to come in the future. But regardless of what happens, I'll always be here, uploading content, providing financial education and entertainment to my current subscribers, who I'm so thankful for, and hopefully many new subscribers I'll be meeting on this video as well. And so today we can see that the market, to close out the day, we're just at the time of this recording, about 10 minutes away from the close of the US market, and my portfolio is up a quarter of a percent. That's good for a cool 160 $63, and it looks like the market on a 1 day basis is up about 0.3%. So having some strong relative outperformance on the day, but that's about it. Thanks so much for stopping by. Make sure to like the video and subscribe on your way out, and I will see you on the next one.